Okay, well, anyway, I know this is an exciting panel. We're on to our last formal panel of the conference, and it's one we always look forward to. It's our annual Distressed Investing Roundtable of some of the leading investors and advisors in the country, and it's usually led by Steve Gidimo, who's looking for you, Steve. And this is the last panel. It proceeds after it. Just want to make sure everyone knows there's a reception upstairs for honoring the turnaround and workout outstanding young restructuring lawyers. So hopefully you can all come and stay for that. I just want to make sure no one thinks that the conference necessarily ends at that point. But we'll do it later. But anyway, I'll turn it over to Steve. I'll talk to you later.
Want to make sure this, yeah, okay, great, it works. Super. All right. So I want to just introduce my panelists. To my immediate left is Gary Hines, longtime head of Delaware Bay Company. To his left is Matt Dundon, head of Dundon Advisors, a very successful firm that's growing rapidly. And then at the end is Richard Fells, Senior Managing Director at Odeon Financial, and one of my, and like these other men, also a dear friend. So, is there a way to get that up there? Yeah, and we start on page 2, the tab 2 there. That one, yep. Okay, super. Thank you very much. All right, so what those of you who've seen it before, what we try to do first is to get some general opinions on where the overall market's going and reasons why. We don't all necessarily have the same opinion, so sometimes the debate itself can be helpful. So without much ado, I'm going to start with maybe Gary, since you're to my immediate left. Or in many ways, you're to my immediate left.
I'm not taking the bait. I just want to let everybody know that.
By this time of day, I warned him as I get pretty loopy, so we'll see if we can take the bait later. So are you bullish or bearish about the market, and do you think it can go higher from here?
I am fairly bullish about the market. I think it can go higher. I think that we're in a Goldilocks kind of period, at least throughout my career, and there's a lot of, there's always, reasons for people to find the opposite, but I think big picture-wise, things look pretty good.
Interest rates and inflation, that doesn't concern you at this point?
It doesn't, and somebody earlier spoke and said, at lunch and said, you have to be well into your 70s for anybody to have remembered the last inflation. Well, I'm not well into my 70s, but my first mortgage was 16.5%.
Oh, my.
And I hear all these, weeping and wailing and gnashing of teeth about inflation. If I see 6% for 3 months in a row, I'll pay attention. But 6% for 1 month.
So I bet that mortgage was 1981.
I think that was about right. Yeah, 1980, 81,
yep.
82. What's it? How big was what? How big was the mortgage? More than I could have afforded. But I'll tell you something else. I didn't have the money for the down payment. I probably shouldn't tell this story, but it's past the statute by now. But I got the seller to take back a second at 14. A second.
Oh, and he.
Yeah.
So the junior security
was
at a lower interest rate.
Than the first, yeah.
All right, so
so anyway, I mean, my point is, yeah, is there inflation? Yes, but is it the end of the world? No.
So Matt, do you think are you bullish or bearish on the general market? Do you think it can go up from here?
So I think that equities can continue to go up. I think that IG is going to be impacted by rates. I think high yield will be impacted by rates, and in a couple of respects, one being that we are going to see, for lower rated credit, some long dated rates that are actually going to bring people back to talking about something. I'm not in my 70s, but when I started in credit, we talked a lot about EBITDA coverage of interest expense. And that's a credit metric that nobody talks about now, because basically companies with any amount of EBITDA are able to cover their interest expense because interest is so low, unless they're on the verge of bankruptcy. So I think that credit is definitely going to be a challenge. I think people are going to, for people who are trying to beat benchmarks, it's going to be difficult. I think equities can move up. The market has shown there's a tremendous amount of resilience in the system, and ultimately, I think we're a long way away from rates that actually pull risk capital out of equity into debt, right? So if we want to think about that rotation, that's driven by significantly higher real yields than I think we're likely to see in the near future. So, and maybe that's driven by the fear of inflation, but it's also driven by the various, fiscal repression methods that central banks have, and the fact that we saw this drama about extending the Fed chairman's term. The indicia of inflation are so severe, and the Fed's response to that is so utterly timid that I think we're not going to see policy-driven tightening of the extent that would actually require to create attractive real returns for folks. So that will remain a tailwind for equities for another 6 or 12 months.
So you say the inflation is so destructive, and yet the response from the Fed would be so timid. How can that be? I mean, if it is so destructive, doesn't there have to be a response by the Fed? And if not the Fed, then it'll be the market at least, right?
I mean, I think it's profoundly politicized and in the wrong way. The Fed is taking the position that we're not at full employment, and yet the job market for anyone here who kind of signs the front of paychecks, right? We're at beyond full employment. We're at negative unemployment, right? Look, good for them. I'm enough of a left-winger at heart that I'm happy my employees have something over me, and employees of fast food chains and supermarkets and what have you have the leverage they have in the market. It's not a bad thing in moral terms, but in practical terms, the things that you would expect a central bank to look at and say, the punch bowl needed to have been taken away 6 months ago, and we need to do, intermeeting rate increases, and we should be putting, whatever is the SOFR equivalent of LIBOR at 5 or 6%. We should be expecting that, and to see that in the next 6 months. That's what you would expect, and they're a million miles away from that. And I think what they're doing is they're hoping that we have so much production capacity globally, so much technology capacity to create efficiency, that this inflation will just go away of its own accord.
That's what they're saying, right?
I think that's what they're thinking.
But that's not what's going to go. That can't happen.
I mean, it's not. Once again, it's not traditionally the way central banks looked at inflation. They would take it's not that they're being guarded or reserved or think that, the actions of the Fed in the early 80s were too extreme. It's just that they are 100% whistling past the graveyard. But I think that means for equities, it's still probably good, because they're not going to be creating those real yields that are actually going to attract risk capital out of equities into credit anytime soon.
Let me ask you a couple of questions, just sort of put a point on. So the 30-year Treasury right now is about 1.86. Okay, we'll call it 1.9%. Would you buy it, or would you short it? Or would you do nothing at this point because it's fairly priced?
I'm never comfortable shorting something that is non-callable for 30 years. I think.
Stay back for 30 years.
Well, but you have to post collateral against how badly it moves against you, right? That's what kills you about being short long-dated instruments. I think that the market the policy makers can distort those markets badly. So I would probably be holding that in a sort of a stacked amount of treasuries. Eventually, I think the market does have to react to this on its own, but the what we call the tools of fiscal repression, right, that hold rates low, they are very powerful tools. And I'm also concerned that the same, you don't want to be on the wrong side of that. And, we all were taught, first day we came onto the trading floor, he who fights the Fed is dead, right? And the Federal Reserve governors have come out and absolutely said we're not going to do the things that people expect us to do or think we should do. And that means you can't construct a rational portfolio or a rational trade against a completely unbeatable foe who's acting irrationally. You just have to stay out of the reach of that guy.
Okay, so let me,
Well, let me jump in for a second.
oh, no, you're next, but just one second. I'm going to throw it right over to you.
I wanted to add to what Matt was saying.
Oh, go ahead, please.
So rational is relative. Rational, according to 70 years ago when we had a nasty bout of inflation, well, what's changed? Well, everything has changed in 70 years. Everything has changed in 25 years.
Well, it wasn't 70 years.
Well, 70, you're talking about the 50s? I mean, that would be 70. Well, you're talking about the 70s, right? That's 50.
Yeah, you're talking about the 70s.
70s.
Yeah, so 50 years ago, yeah.
The tools that the Fed have aren't just focused on North America or on 50 states. We have a 30-year rate right now of 187. We have a 10-year rate somewhere just under 160. Well, who do you think is buying all those treasuries? Everybody else in the world. Because what are their rates? 0.25%.
Right, but I can tell you
Negative.
I can tell you $6 trillion that they haven't bought because the Fed owns it.
So in some ways, we have to rethink what's rational. And as Matt pointed out, the equity markets can be very rational, particularly the best of class. Last year, we talked about here post-COVID opportunities, and we talked about coming back of airlines. We talked about coming back of cruise lines. We talked about best-in-class consumer good companies, one-stop shopping, delivery to your door. They've all done fantastic. Was that rational 10 years ago? Would we have thought that there was Grubhub would be bought by Uber, or that all these services we would use on a daily basis now? So I kind of agree with my co-panelists that equity is where it's at because it's the new rational. And my opinion, as far as equities, is stay in best of class.
So, Richard, just on the inflation and the interest rate question, are you worried about inflation? And would you buy, sell, or hold a 30-year bond at 1.87?
Well, one, I don't have a need for a 30-year bond.
No, it's a trade. I mean, it's not, no one's going to hold it for
Well,
30 years.
and I'm going to explain. I wouldn't buy or
aren't
sell
eating
it because
sardines.
I wouldn't even be looking at it. Why wouldn't I buy Exxon? It's paying a 3%.
No. So no, I'm saying the question is if I think interest rates are going to 5%, right? For every $1 million you're short of a 30-year bond, it's going to 20. It's going to 200. I mean, it's going to.
I would not be buying long-term government bonds
You would not.
unless
Okay.
I had a need.
Right. I mean, just again to go through the math of it, right? If the interest rate this morning we talked about 8% at this kind of inflation level back in 1991, if the long 30-year bond goes from 1.9 to 4, right? Every $1 million of bonds that you short at a million, you could buy back at $400,000. That's a $600,000 profit, 60% profit. Now the question is, how long does it take for that to go, right? If we're at 4% next year and you're short this year, you've made a ton of money, and I think probably it'd be one of the best. Now, so my question, because I've been short these things, and we have taken off some because of there were some deflationary pressures in the last couple months, and now they may come again, as we talked about this morning with COVID. I mean, not the COVID, the new variant. That'll be very deflationary, and therefore, because everybody's locked down and we know economic growth, if that happens, then the interest rates go down again, right? But for that, all I see is why aren't the interest rates, to sort of Matt's point, why aren't they at 3%, the 30-year? I mean, even at 3%, that bond is worth 60, right? I mean, that you buy at 100 is worth 60. If I'm short that's a pretty nice gain.
Right. Well, you're talking about a fixed income trade. And then I interrupted Matt when he was moving from equity to fixed income in general and saying, why even be there?
YMB where? In equities?
In fixed income.
Oh, in fixed income. Right. Well, at 1%, why be there? At 1.5% or whatever. Yeah, excellent. Absolutely. You want to be there if.
To
Yeah.
Matt to finish.
I mean, the answer is, if the question is why be in credit at par, right? It's all about unit of return per unit of risk, and I think it gets most people are in credit at par because they have to be, right? The vast amount of fixed income is held by people who only can buy fixed income, right? So you really have, it's a tiny corner of the credit market that is opportunistic, that is able to buy high yield, that can move back and forth between high yield and equity, and that's fine. But most the vast majority of credit investors are price takers, right? And what I think is interesting there is we don't know when the Fed's going to do what they're going to do. To me, it's not safe enough without the kind of term borrow that JP Morgan is not going to give me to be short, long dated, non-callable credit. But I do feel that we are going to see sooner or later some significantly higher rates, whether they'll be, whether they'll be positive real returns, I don't know. But they'll be high enough that weaker credits are going to be threatened. They're going to be high enough that CFOs of investment grade companies are going to say, I don't really know if we need to go out and issue bonds to fund a buyback of our shares. So there definitely could be some behavioral changes that are very important when you're thinking about how you set up your portfolio. But what you want to do is you want to set it up so that it works. What if this crunch happens in 3 months, 6 months, 9 months, 12 months, that you're not trying to kind of having to catch a wave, because that's extraordinarily difficult, particularly when, as I said, you've got the most important policymakers in a committedly irrational posture.
Okay, so Matt, let me just jump in. So we got some other topics here. So it sounds like that Richard, Matt, I think Gary's not on the same page, and myself are all saying rates probably going up. We'd probably be better shorters of the long term, 30 years. I'm putting words in your two guys' mouth, and that's our view on the interest rates. Let's just switch now to some of the industrial sectors. In these things, I like to go from macro to industrial, and then we can go company specific. That's sort of part of our training. My training as an investor. So real quick, would you guys be? The airlines have received a good recovery recently, and it bounced back. We showed the slide this morning that Delta is almost back at the earnings level of 2019. Would you guys encouraged about what's going on with the airline industry? We'll go the reverse order. How about Richard, Matt, and then Gary?
Sure. I think the airlines need to exist. There are many airlines around the world that are suffering. Philippine Airline, LATAM, Aeromexico, Avianca, and multiple airlines.
But most of those are country airlines, aren't they?
Partially, and many of the airline financing companies are having trouble. I think that they're fully valued here, and I would not be a buyer.
Okay.
I believe the airlines are significantly overvalued, and would be a seller. I think that the forward curves on fuel are very discouraging. The prognosis for recovery of business travel is very discouraging. There's a significant driver, particularly for when you get to the lessors and Asian airlines. The Asian countries and Australia and New Zealand are highly reactive on COVID. I mean, we just basically lost 6 months in the last week in terms of the reopening of travel in pretty much everywhere in Australia, New Zealand. Everyone is repositioning around that. It's just done. So Japan won't be open until September of 2022. China, it's now 23. Vietnam probably 23. Australia, New Zealand, late 2022. That's just the, and they've been in it long enough that they've anniversaried it. The tourist businesses that are gone, right? And they're no longer complaining. Those people have been repositioned and they're looking for other opportunities in the marketplace. We are invested in the biggest, in a foreign language teaching, business in one of the big countries in Asia, and we're having a call and we're like, look, their primary driver have been people who would individually enroll to get into the tourist business. We're just like, no, you're supposed to be selling to business now because of the global supply chain issues that a lot of smaller companies are going to be able to penetrate North American and European markets, and you need more business English speakers, right? You forget about the tourism, like never coming back, or it's not coming back. So I think that the way that the airlines and some other have recovered is just an example of a lack of opportunity and kind of a grab for yield that is not well thought of. And I suspect
on the part of investors, you mean?
On the part of investors, right? It's just something where, if something can be argued to be cheap, people want to be in it in a world where everything is rich, but something should be cheap. And I think I think the earnings picture is pretty dire for the airlines. I think they're the large carriers and will get more bailouts in economies that have the depth to give those bailouts. So I don't really know that it's a distressed situation. There's probably some good secured credit trades that make sense, but overall the picture is grim.
Gary?
Well, I think the airlines are fairly priced in here. I would agree basically with Steve's position.
Steve's position.
Steve.
Matt.
No, Richards.
Richards. Oh,
Yeah.
Richards. Okay. It's,
I agree with Steve's position, whatever it's going to be.
Exactly. I've been trying for 20 years to get Gary to say that. Well, Gary agrees with me on any position, I think. Okay, so let's go. My turn would be, I'm also worried. It's like, I think Matt said it, I'll say it differently from what Matt, but it's the same point. It's like, we're not getting back to 100%. I mean, if you looked at, like Disney, I can see Disney getting back to 100% of 2019 productivity and efficiency and revenue growth, right? Because families that have kids are still they're gonna just rip off those mass kids or keep them on, whatever. We're going to Disney. But I don't think the airlines are in that situation. They're essential, I think, as Richard started saying, and as being essential, they have a reason to exist, and therefore there's a price that they are worth owning. But I do agree that they've maybe run higher than they should be, given that the market might be pricing them for 100% return to normal, and it's not going to be that way. There's not going to be the international growth. I have family in Hong Kong, and they're telling me that anytime they make a trip, it's a 14-day, I think it's a 14-day forced quarantine in a hotel in Hong Kong, which is $1,000 a day for like up to 4 people in one hotel room. So if you have a family of 5, it's 2 hotel rooms, so $2,000 a day for 14 days. So your trip to wherever you want to go now is you have to tack on an extra 30 grand to basically and shut yourself down for 2 weeks, which I think was what Matt was talking about. They're making it onerous in Asia, and maybe it's helpful to the rest of the world. They could have done that in December 2019, but they didn't. But nonetheless, I think that's this non-return to normal that may already be that might be priced in on some of the U.S. carriers that we're not really seeing. We're seeing or feeling that the way it really is going to play out. So I would be a better seller than a buyer of those. How about quickly retail, and then we're going to go to some specific company situations. Who wants to start? Matt, why don't we start with you on retail? We start.
Retail's good. I mean, the story of the last year and a half has been that demand is strong, and I think that we shook out last year. I mean, to the great benefit of my firm, we accelerated 2 or 3 years of retail defaults into one year into 6 months.
It's a bull market.
And so right now, I think there's very few retailers that are not financially strong. They have extracted significant concessions from landlords for brick and mortar stores. It's a good space, and high demand is good, and I think they're managing supply chain issues so that they have goods on the virtual shelves to the extent they can. There are interesting, and they're able to take price, right? And so one of the hardest things that you have to deal with as a retailer is keeping other retailers from being so promotional that you can't make money. And so right now, I think the retailers, obviously not through any kind of conscious conspiracy, but are effectively, watching each other's backs. And one of the things that happened in last year's default cycle is some of the most aggressively promotional merchants went into bankruptcy, got sold to relatively disciplined, or taken out of bankruptcy by relatively disciplined ownership. And so I think that gross margins are going to stay strong and very healthy. I mean, once again, I think the market is not giving you a lot of compensation for that. It's not like there's a lot of wow, 8% dividend yields and bonds trading at 9% that sort of fall into that bucket. But, as a sort of a sector to be underweight, I would not call it one at all.
Okay.
Right.
Richard?
I agree with Matt. Just wait Wednesday morning to see the numbers over the last 4 or 5 days. They're going to be crazy off the charts. Last year, on 4 days, Walmart did $5.1 billion, maybe it was 5.2. That would be a guideline to look at what Walmart takes both online and in store. I expect it to be higher. I expect their margins to be in line. And I don't think enough is being said about the good operators out there. Walmart owns, Costco owns their own ships. They do their own manufacturing. They're light years ahead of a lot of these smaller companies. The smaller companies, the niche companies, maybe you can get some yield, you can get some, movement in their equity. But on all the big players, these are just standard, best-of-class investments.
They really
I
have.
think retail is extremely strong. I don't get it, but it is.
Well, so you're talking about, you are making a designation between the big brands and the national
big brands
brands.
rule.
They
just rule.
they've rolled up the little
Look
guys.
at the numbers coming out on Wednesday. They just own everything.
Yeah, I was had the benefit of driving through parts of rural country Pennsylvania, where I have a place. And I drive through a old town, that was probably once a thriving town. I drive past the other day I drove past something that had Five and Dime on the outside, and I said, a Five and Dime store to my 15-year-old daughter meant that you could buy everything in the store at 5 cents or 10 cents, and she's like, I'm not even sure she knew what a dime was, but she, five like that. Is that the $10 bill you hand me? No, it's,
But now you can buy it for $1.
Steve, just last week.
Now you can buy it for $1.
Five and Dime.
No,
Yeah.
they went to $1.25. The dollar store is going to $1.25.
So it's $1.25 store. Okay, well, then we've got to rebrand that a little bit. And so I was telling her that that there were these downtowns we'd go and shopping at, and like the Five and Dime store. Now it's basically all. Well, first I told her it was not just all wiped out by Amazon, but it was first wiped out by the malls, right? Which she's now discovering, and so there's the malls and then to Amazon. So, what do you think, Gary, about retail?
Well, I think if you're not Amazon or shipping through Amazon, if you are the biggies, you've got the world by the tail.
Yeah.
But all these other, it seems like, why would you put up a distribution warehouse anymore? When are you trying to? Oh, sorry. Why would you put up a distribution facility anymore when basically you can do it to Amazon?
You're used to people just listening to you no matter whether you have a microphone or not. Isn't that true?
Why don't you listen to this?
It's like being chairman. You've been chairman too long of things, I think.
Listen to this.
All right, sorry, what were you saying?
I finished.
I did. Okay. Distribution centers. Okay. So how about so let's move to the next page. Now we can talk about some specific credits. Carnival Cruz. Who wants to take this one? Rich, you want to lead us on Carnival Cruz? What are your thoughts on that? So just if we could get that on the next page. So hopefully it'll come up on the screen, but the stock is $18 right now, up from like $4, a year ago. The 9-month EBIT, which is earnings before taxes, but adding back depreciation and amortization, is a negative 4.3, if you can sort of see that. And net debt, which is cash, debt minus cash, is 23.6 billion. Now, obviously, that's not sustainable if the negative EBITDA is going to stay where it's at. And they have maturities of 2.4 billion next year, and then basically 9 billion over the next 2 years. And they have about 7 million of cash, which is netted out of that number. So Carnival Cruz, I would say, just to lead the discussion here, it's not, we discussed this earlier, it's not essential like Delta or the airlines. And so how do you see this?
All right, so as an investor,
And at $18, would you buy or sell that?
as an investor, Carnival Cruise fits a niche, and the boats are big and beautiful if that's what you're looking for. But just like our lunchtime award recipient, Jeff, had mentioned, this is a great example of distressed investors talking themselves into a wonderful recovery story, in my opinion. I would not be a buyer. I think it's a well-managed company. I'd like to see all these cruise lines succeed because I think it's an important niche that they fill. But there's no interest here. I don't see how they're ever going to earn themselves out of their liability side.
I love the short-dated debt of these companies. I mean, the yield, once again, the yield's not super attractive, but I think the market will
What's the
super
yield?
gladly refinance them. So from a sort of yield-to-call perspective, yield-to-maturity perspective on the short end of the curve, it's attractive.
What's the yield?
Low single digits.
Like 3-4%?
Five-ish?
Yeah, but still hundreds of basis points spread over risk-free for the short term.
So if you're saying 3 or 4% for about a 9-month piece of paper, that's huge. for
Right,
a short
well, because if you're in that short end of the curve investing, to my mind, there is no doubt that they'll be able to refi out the capital structure. Credit investors, want to be backed by real assets. And look, the fundamental demand for cruising is unaffected. It's better than ever, probably. I think anybody who did any traveling this past summer recognizes that, the appetite for leisure and the money to spend on leisure is there. In terms of the stock, I think that don't spend enough time in that piece of the industry to have an opinion. But I think that the idea that the company will have very strong bookings in 2022, and I think that once again, when we turn to Asia, they can do cruises that don't have foreign destination, and therefore one of the few really lavish vacations you can do if you live in Hong Kong or you live in China, or you live in Australia, is going to cruise to basically nowhere and come back. I think that could be a very nice business for them, and then people don't have to be quarantined. So I think it's healthy, and I also just think that there's enough schmucks in the credit market that they'll be able to push this thing out, even if you might say that 3-4 years they'll never have the EBITDA. Unfortunately, we just know that there's enough people who will buy those bonds that the short-dated credit is probably a good trade.
Okay.
I would agree, because I think beyond the short, there's just too much debt here. And
Too much debt.
Too
on
much
the
debt.
company. Oh, you
debt on
agree
this-
with,
yeah.
Matt was saying something slightly different.
Yeah,
Or you
right.
agree?
I agree with Matthew in the terms of the short term and the schmucks in the market and all that, but longer term, this company just has too much debt.
Has too much debt, so it's a restructuring, you think? Headed to a restructuring.
Eventually.
Yeah, that's not bad. I think so. I look at the situation and say, if this thing were to file and I'm in the secured debt, am I going to get hurt? And I think you're going to get hurt in the short term as it marks it down. But sometimes you have an underweighted position, then if it defaults.
And you can get hurt in the long term debt.
Well, I mean, if you file, there's no long or short term
Could be
anymore.
a
It's
nice
just
place to
all.
live, Steve.
No, I don't like the water like that. But
Don't need a staff of like 200.
oh, that I like. No, but my point would be that the assets are so kind of wonderful. I mean, and that if you have decent asset coverage, if you could sell those boats for 60 cents on a dollar and still not get, and there's still enough debt to take care of the senior secured debt, that's a place to be. But that's probably priced into the market, which is what sort of Matt's point. But I would agree that the short-term dated paper will get refinanced out because they can't pull the plug this year. They can't pull the plug before even mid-2023. But so it's interesting. The 22 maturities are probably, for most of these companies we're talking about, maybe that are probably buys, and then the 23 risky buys, and the 24, hold on to your hats. I mean, who knows? Because if we're still in lockdowns, I don't know where we are with a company like this. So now it's a little bit of a surprise. We can change one thing that is starting to get some more notice, and you'll probably read more about this in the next coming weeks and months. There's a topic called ESGs, which are environmentally, socially, and governance responsible companies, and some funds are out there raising money for just ESG kind of investments. And so we've, as a group, decided to focus on, so there's some positives and negatives. Like the negative, the ESG companies want you to get out of guns. Like Remington Arms took it on the chin with that. All the coal companies are getting hit. Investors are telling, activists, noisy investors are telling their investment funds, we don't want you making coal investments. And I think the university endowments, which are huge in this country, get to see a lot of activity on that. On the other side, things like solar panels, whether they're profitable or unprofitable, our solar businesses are encouraged by these university funds, to go into that. So you may be pushing on a string there because maybe the technology is not yet ready for that, which is sort of an anti-capitalistic idea in the sense of you want to invest when the technology is there and it's really ready to go. And now we see another one that people are encouraging to be the marijuana companies, which are are on the positive side of in college endowment would be encouraged to invest in marijuana companies. But we chose to stay away from all that political discussion to get something slightly political, which was the focus on prison operators. And we have two companies. One's called, and you could just get the ticker and you can do more work on the CXW, is called Core Civic, and it has 70,000 beds and correctional facilities nationwide. And then the other one is the GEO Group, which is ticker is GEO, and that has 86,000 beds and 107 facilities. Now, just again as background, which this group knows, is that on January 26, 2021, so this was early this year, I think 5 days into his presidency, Joe Biden signed an executive order that the DOJ, the Department of Justice, was not to renew any contracts with any prison facilities in the United States.
Federally. States are done separately.
Right, okay, right. So any federal contracts with correctional facilities like Core Civic, because they're national firms, and GEO would not be renewed. And that leads up to a host of questions. But as a result, these stocks have taken it on the chin. And the bonds are equally interesting. They're trading at like 9% yields and so. So I put up some numbers here where, unlike some of the other, like the Carnival Cruz, these are actually positive EBITDA companies. So Core Civic, $100 million of EBITDA for 9 months, and cash on hand is about $500 million, and the debt is, if I can read that right, $1.6 billion, and the equity capital is about $1.3 billion. The GEO is slightly larger because it has a little bit more beds. It's $225 million of 9-month EBITDA. Cash on hand is about $570 million, and the debt is 2.6, almost 2.7 billion, and the equity cap is $1 billion, which is less than Core Civic. Both these companies are struggling with the issue of what's going to happen with the renewal of the contracts. Who'd like to get this started? Rich, you want to start this?
I'm just going to start. When this conference and we started talking about preparation, one of the first things I wrote down is be mindful of ESG targets in 2021, 2022, and going forward. GEO is a great example of the struggle and the difficulties that a ESG concerns and ESG targeting efforts can have on a company. GEO is having difficulty refinancing their bank lines because out of their group of 12 or 15 lenders, 5 or 6 of them have already said that they're not going to renew or extend. On the flip side, management has jumped to the challenge, and they've retired $175 million worth of debt this year, and they're continuing to. But this hurts them. This hurts the public good because we have correctional facilities, and the way we think about correctional facilities over a multi-generational span has changed. It's a messy business. It's always been a messy business.
But you don't think that there aren't hedge funds out there desperate for yield that aren't going to step into the place here?
Well, I think they are stepping in. And I think if you see the transfer of ownership on GEO from 18 months ago, it's moved from the better quality, high yield mutual funds to distressed players.
So both CoreCivic and GEO have they're hundreds of basis points wide. One is single B rated bonds, the other are double B rated bonds at their unsecured level, and they're trading as hundreds of basis points wide to the index, which I think is a tribute to the hedge funds can only do so much to step into something that is being avoided not only by the large banks but also by a lot of regular way high yield investors, and I think they're canaries in the coal mine for the impact of ESG broadly kind of coming into distressed credit. And I mean, I can tell you that if either one of those companies, so first of all, Congress is having a problem, and I should disclose that we are part of, and let's call it an effort against, we advise a large set of consumer and worker litigations against the GEO group, and are very familiar with those things, so I have an interest here. Paradoxically, I have an interest in both their being bad and they're having enough money to pay me for being bad, which is a tension that my clients and I have to live with. Despite the big talk coming out of liberals in Washington, they actually have nowhere else to put the prisoners. And so one thing that's happening is the contracts are getting renewed and extended for all that the president and the Democrats in Congress wish they didn't, because they have nowhere else to go. And that includes both the convicts, the detainee, the people who are in jail because they can't post bail, and the immigration detainees, where it's most controversial because immigration offenses are civil, not criminal, and they're being treated as if they're criminals. And so this is a very unpleasant thing for a lot of policymakers, but they just can't release everybody and they don't have anywhere else to go. But yeah, the banks that are in the facility, they would love to see this company go into bankruptcy because they would think, oh, someone else is going to take us out in the dip, because we have to tell the activists internally who are holding our feet to the fire, like, why are we still in this credit? But the problem is, who's going to do that dip? The same big banks or not. And I think that there needs to be the premium you see in the secured and unsecured debt here. That is going to come systemically into every ESG disfavored market, because big credit is just not going to do these trades. And to me, the most interesting thing is it's pretty easy for private prison operators to be targeted, but it absolutely will not stop there.
Well, I'm sorry, what won't stop there?
Right, and all the way down to the distressed end, there just are not enough unrestricted hedge fund dollars to make up for, a credit being a certain kind of industry being uninvestable. And by the way, hedge funds get their money from the exact same place, right? They're just one degree of separation, and it will absolutely come in mandates. Fund of funds are starting to ask even the most opportunistic, go anywhere, amoral credit investors, what is your ESG strategy? And so when you're going to have Avenue and Elliott and other big players having introduced broad-reaching ESG that does not exempt their distressed and opportunistic books, you're going to have to think very hard where this capital is coming from and the premium in which it's going to be priced.
Well, Avenue gets a lot of his funds from labor,
And
teachers' unions and stuff, so
ESG
he has to be.
is like, it's the flavor du jour
Yeah, for the moment, yeah.
for the moment. At some point, people are going to have to wake up and realize the purpose of making any investment is to make money. Now, you can put all kinds of handcuffs on and everything else, but at the end of the day, as Richard says, where are you going to put these people?
Yeah.
You can put out an executive order saying, don't renew this, don't renew that. Okay, what are you going to do with the people? And I think a lot of ESG proponents, frankly, are not living in the real world.
Gary, in this light, you do remind me of Ronald Reagan. I want to just say.
There he goes again.
I mean, just maybe it's the way the light hit just at this hour. Maybe, good, God bless you.
So
Half the people here didn't get that.
No, everybody got it.
No,
What are you talking about?
There he goes again.
Oh, that.
I mean,
There he goes again. Yeah, exactly.
I
The
think
Walter Mondale thing.
I think the pressure on institutional investors to have and abide by probably ever more restrictive ESG policies is not going away. I think that is a secular change in the marketplace, and it is like every other kind of, let's call it maybe politicized trend that we've seen affect business. It just gets priced in, right? And it becomes part of what people have to do, and if it's expensive, so be it. If it reduces returns, so be it.
So Matt, let me just jump in. So, do you see that either of these two companies or both possibly heading into bankruptcy?
So it would require that, in this space, it would require a level of political resolve that I don't think necessarily exists. It also, frankly, requires.
So what do you mean by level?
So
of political?
it requires that you have to do one of two things to take these guys out. You have to build more public prisons, which is an extraordinarily expensive undertaking.
Well, that won't happen in this environment. So,
well, right, and also these prisons are cheaper than this
Yeah.
industry exists because they could build prisons without complying with prevailing wage laws, and they could operate them, with private sector, non-unionized labor for the most part. Although Geode actually does have unionized guards, but they're not paid very well.
but they're not government unionized. It's
Right.
a slightly different price point.
Or it's simply saying we're going to decarceralize, as they say, a big section. We're going to say that there are going to be no immigrant detainees, that every single person who is detained
but
is
that's all
released.
nice. But it's a bankruptcy group, and do you think
So,
we have
I
a potential client here?
So the answer is with both of them, yes, in part because I do think that they can chunk away at it for the next year, and then secondly, I think that the strike of capital against them is very significant, right? And because of the growth of ESG.
And Richard, what do you think?
So what I started, and I remember, I didn't say beware of ESG targets. I said be mindful of ESG targets. Now, we're talking about the negative. Okay, for distressed investors.
No, Gary, it's a specific question. Bankruptcy or no? Is this a possible bankruptcy risk? These companies, these clients, are these potential clients?
That's a good question. I don't know.
Okay, that's a fair answer. It's okay.
I really don't know.
Gary, what do you think?
I don't see it in the near term, no.
I agree with you. I agree with you on that. I'm not sure I see it in the near term, but definitely keep an eye on them, because if they're really going to execute on this executive order, they're going in, right? I think it was either Matt or Gary said that they're not executing on the executive order, and therefore they won't go in. And there is obviously no alternative, which would be, I mean, if they file, boy, I want to be involved.
Well, Steve, that's why it's important for us to spend about 3 minutes to understand that down the road, there is another opportunity for the distressed community for ESG targets initially on the positive side.
No, I get that, but we're running out of time, and I want to get to the Fannie Mae thing. All right, so Freddie Mac.
Of course.
Okay. Of course.
Gary is right.
So Gary, I'm sorry, this is our annually decade update on our tri-decade update on Fannie Mae, Freddie Mac. What's going on for what's going to happen in the third decade of the century with Fannie Mae, Freddie Mac?
Well, it's, Britney Spears is now out of her conservatorship.
Didn't see that coming.
So that just leaves us, Fannie Mae and Freddie Mac. Two of the most profitable companies on the planet, make money hand over fist, and they're still in conservatorship. There are some court cases that are percolating that are going to have developments in the spring and summer of next year. The administration, I think, probably will appoint a permanent head of FHFA, that's the regulator, later this year, early next year. They've got to do something between now and the election, otherwise they'll have to turn it over to the Republicans, and they can't use it for
They
affordable
don't have to.
housing.
Biden can veto it, though, right? So, I'm sorry, Ron. I'm
So,
sorry.
I don't know what to tell you. This thing has been well behind schedule. But the bottom line is, you can't run an interstate highway through the family farm without compensating the farmer that owns the land. That's in the Constitution, and I believe that the preferreds, especially the Fannie S, the on-the-runs are Fannie S and Freddie
Yeah,
J.
the J and the S, yeah.
I think they're worth par, and at these levels, 3.5 or 330, you can, do the math. Pick whatever your desired ROR is, but you can go out a long time to get a very attractive ROR.
Right. So let me just back this up for those not at the previous 10 conferences. And Gary's had a history of really some big wins over a long time. So the Fannie Mae, Freddie Mac are literally the preferred stock. It's a thin layer, about $100 billion or something. 33 billion. Okay, among a capital structure that should be hundreds of billions. 6 trillion. Right. So it's a thin layer between some senior bonds that'll eventually be put on there, and then this massive equity. And obviously, Fannie Mae and Freddie Mac insure every mortgage in the country. It's what makes our housing market so vibrant and which so different than every other housing market in the world. Our people like to pick on the financiers, but we've created the home ownership that the world envies, and Fannie Mae, Freddie Mac has a role in that. So what happened in the 2008 timeframe, so that's already 13 years, is that they were near insolvent, allegedly. Gary disputes that, and the government cut a deal with them, admittedly a bad deal for the Fannie Freddie guys who were sort of quasi-government anyway. But as a result, as they got back on their feet, they were basically throwing off about $1 billion of cash a year, roughly.
More than that.
More than that, okay. And that cash would actually go right into the federal budget, if as long as they kept it. So any politician would have, any president basically, would have a strong incentive not to solve that, right? Because it's like, why wouldn't I want $1 billion that no one else is, or a couple billion a year that I don't have to account for and no one's really asking me about? It just helps the budget. You can do things with it. I mean, you go into the federal government and then you could allocate it out to where you want to do it. The Trump administration was at the threshold, and Gary's in the middle of this, that basically if they were reelected, they were going to get this done, and Gary's upset that they should have got it done before the election, but it's complicated. They had to do big financing, which the market was going to wait till after the election to do it, and they probably by this time would have been done, and if that's the case, the preferred stock at trading at whatever level is going to get refinanced out at 25 plus accrued interest, I believe, right?
Not plus interest. No.
Not plus interest? Okay. All right, so $25, right? And if it was going to be refinanced out, and which was going to likely be done. So at one point last year, before the election, was at 12, I think?
Yeah.
12, right?
12.
Yeah. Now, if you're marking a lot of bonds at 12, a lot of preferred at 12, and now, after the election went down to $1.50, that's a little bit of a hit in anyone's portfolio. There was a great line that I spoke to Gary shortly after that, and he said, one of his friends called him up and said, I've always been looking for a 20-bagger Because if it's at $1, you're going to get 20 times your money. Whereas if it's at 12, you're going to only get 2 times your money. So he went from a 2-bagger to a 20-bagger, which is usually a good thing, but it's, in this case, maybe not such a good thing.
It's in my opinion, and I've been doing this for 40-plus years, this is the trade of a lifetime.
Yeah, I agree. And so,
Now, I don't know whether it'll be this year or next or 5 years from now, but it's the trade of a lifetime.
right. So I'm in there with Gary because we're friends, and he's convinced me on this thing. And so I'm in there at 12, holding on because I'm thinking, well, if the election goes a certain way, you're looking at $25 in 6 months, right? So you can double in 6 months. And then I'm marked down at 150, but we did buy more down there, which has now almost tripled. So, but now I'm not. Gary and I disagree on this. I'm not optimistic the Biden administration will address this necessarily.
Well, I think they have an incentive too, in that they can use them. They did not get the money in the budget for affordable housing that they were looking for. And the government owns, through the warrant, 79.9% of Fannie and Freddie, which estimates, I've seen estimates of 100 to 150 billion of what that could be worth. To give an example, AIG, the government took back warrants there, and they made, I think, 25 billion. That was a small piece.
Oh yeah, I remember that. Yeah,
So
exactly.
Gary, would you say it's fair to say that the government has gotten hedge fund type returns from their loan?
Oh, it's been the best deal since the Louisiana Purchase.
So we're going to have to cut it here.
Better,
But
better than hedge fund returns. I mean,
we're going to have to cut it here, but I do want to say what I love talking about this story about this every year with this is that Gary, of course, is the former Democratic chairman of the Delaware state group, and has personally been in the basement of our current president multiple times. Right? So those of you who love delicious irony.
but that doesn't mean anything. I mean, the last time I don't talk, and I want to make this clear, I have no insights into the administration. I have contacts. What they do with my stuff after they get it, I don't know. I have not talked to the president about this. The last time I talked to him at all was about a month before the election, and it was only for a few minutes. So I just want to make that clear. I don't have any inside information here.
But so those of you who love delicious irony, this is just too much. Just like a feast up here. So, all right. With that, thank you very much. Very good.
Good job. Good job.
Well, thanks, everyone. That was a great panel. Gary is Chicago. Could you just say, wait for next year? Well, everyone, that concludes the program here today. And we in Beard Group want to thank everyone for coming. I want to thank the Beard Group for conducting this. This was a test of strength to do an in-person session this year. And I hope everyone thinks it turned out great. Following this panel, I believe we can go to the 5th floor. There's the reception for the turnaround and workouts list of outstanding young restructuring lawyers. And I hope you all can make that. Again, thanks for coming. We want to also thank the sponsors of the conference. And I'm going to pretend I'm a rolling screen here and read them. I won't read my own firm's name, Foley, but it's Kirkland & Ellis, Morrison Forster, Development Specialists, Denton's, Riveron, Berkeley Research Group, Locklord, Kalari Partners, Hilco Corporate Finance, SSG Capital Advisors, and our knowledge partners, Pacer Monitor, Leffen Insights, and our media sponsors, Bankruptcy Data, and the contributors. Anyway, again, thank everyone for coming. I hope you all enjoyed it, and I hope as many of you as possible can stay for the reception upstairs.